Welcome back to Your Money Matters. I am Angela Giroux, and joining me are Ted Bauman and Clint Lee. I've said this before and I'll say it again. If you haven't yet joined the Bauman Letter, please do. We put together a great deal for you. Check it out. You can join us risk-free. There is a link above with all of the details. In addition, if you haven't yet seen Ted's video from Friday, I highly recommend that you do. He talks all about the effect of options expiry on the markets last week. But of course, it's not the only thing on investors' mind. We're all worried about Fed tapering. And I think it's really easy to forget just how much support the Fed has given the stock market. But I was reading an article this morning. I wanted to share it with you guys. And it pointed out that collectively, global central banks have spent $834 million an hour on purchases for 18 months. Now, bear with me, because I know we throw out a lot of numbers, millions, billions, trillions, but $100 million bills, if you stack them up from the ground, it reaches the altitude of a commercial airliner. And we're talking over 8 times that amount every single hour. It's mind-blowing when you really think about it. And I'm going to show a chart that really shows what I'm talking about here.
Nice to be able to print the money, isn't it? That's a handy, skill.
But it's true. We use such big numbers. It's so easy to forget even how much, 100 million is when you're talking about the government, but it's a lot of money. And you can see how they have just been plowing into the markets these last 18 months or so. Of course, you see that jump in 08, 09, and then steady. It just takes off like a rocket. Now, here's another chart, because this is what I'm saying, and you can see how the stock market has tracked the Fed's balance sheet closely. I mean, they're moving up there in lockstep. So, Ted, it probably goes without saying this is unsustainable. But what happens now, and how can investors prepare for what comes next?
Well, one thing I would just refer back to that earlier chart that you showed. There was a dip between 2018 and 2019, and that was when the Fed tried tapering before, or there was talk of interest rates. So, I mean, history proves that when they start doing this stuff, the markets do tend to pull back.
Didn't work out so well, did it?
Didn't work out well. Powell learned an important lesson that time. I want to show a chart that just reinforces what this has been like. This is a chart that shows just the all country world stock index, the year-on-year change, and it shows just that this rally has been by far the biggest one in the lifetimes of a lot of people on Wall Street. And it's just it's hard to imagine anything more. I mean, that just the amount of stock buying, money flowing into equities over the last year or so has just been extraordinary. So I think we dodged a bullet. Because last Friday, there was a bit of a rebound. We're recording this on Friday, so, hold thumbs, who knows? I mean, it could turn around. But I think my thesis that, things would calm down after the options expiry is being proven. But there's still, the tapering issue. So the big question is what happens, when you have a pullback? Now, we haven't had a 5% pullback in the stock market for over 200 days. Here's a chart that shows historical trends, going back to the 50s of how long, markets have gone without pullbacks. Now, it can go a lot longer than this. I mean, it's between 2016 and 2018, it was about double. So it can still happen, but it just shows you that, the higher you get, and we're a lot higher than we were in 2016, 18, the more the market becomes like a mousetrap. So the likelihood of a cascade, as some people call it, increases. The problem is that a lot of the old hands on Wall Street are starting to say, well, there's a bit of complacency going on here. And, one of them pointed out a lot of the people working in the fund management industry and hedge funds, on Wall Street, they only know growth in the stock market because they got into the industry after 2009. And, they've been doing this and they've never seen a market pullback. And so they're a little bit too sanguine, a little bit too trusting of the market. Here's Citibank's panic euphoria model. It's essentially, they put together a model that shows the 12-month forward return, their measure of PE, and then how that illustrates where the market is in terms of euphoria or panic. right now we're very much in euphoria mode, but you can see on the far right-hand side, it's pulled back a lot since the beginning of the year, but we're still very much in euphoria mode according to their measures. So what that tells us is that, as Jimmy Cliff said, the bigger they are, the harder they fall. Well, it's the same with the stock market. The higher they are, the further they can fall. So the big question is there a potential for a pullback if the Fed gets serious about tapering? Let's talk about it.
Let's talk about it, Clint. I'd actually like to ask you, we've been sailing along pretty smoothly, but it's getting pretty toppy. And like Ted just said, this talk of Fed tapering is really picking up steam. So if we do fall, how far do you think we could fall?
That's really putting me on the spot to make a prediction. Well, before I answer that, the one thing, what's that?
She said could. Not
Good,
will.
that's true. Very true.
Potentially.
Potentially. Potentially a lot. One thing that I would point out about the markets in general is just how, I'll call it how mean reverting they are. It means we get stretched too far in one direction, and we tend to snap back, whether that's to the downside, like we saw, during the pandemic sell-off last year. But right now we're seeing a lot of different measures showing that we're just getting stretched further and further to the upside. So let's take a look at a couple of those. One's on the valuation side. So here's one chart I'll show. This is an average of four different, they're longer term trailing valuation measures, things like the cyclically adjusted PE ratio we've talked about before, that smooths earnings over the last 10 years or so. There's something called the Q ratio in here too, that looks at the market value relative to what it would cost to replace assets. So there's a lot of just longer term measures in here. This goes back to 1900, but what this blue line on here is tracking is the average of those measures relative to its own average historically. So the solid red line through here that says the mean, that this blue line shows you how far above or below we are relative to that mean going back once again to 1900. And so now if you pan to the right-hand side of the chart, you see that we are the furthest above the mean that we have ever been, over 3 standard deviations. So it just shows how stretched we are from this valuation standpoint. Now, I know one thing that someone would probably try to throw back in your face is, well, those are all trailing valuation measures. We're expecting earnings growth, so it doesn't look that bad. Well, here's a chart showing the forward PE ratio for the S&P 500, and it's not as bad in terms of being above the dot-com bubble, but we're right there. I mean, we're right around 21, 22 times on forward earnings estimates. And that's just below the 24 level that we touched back in the dot-com bubble. So we're seeing valuations that are stretched to the upside. The other thing I like to look at is the trend of the market as well, the trend over a longer term basis. And so I'll go to one of my favorite indicators. I want to talk about the MACD.
Everybody take a drink.
I can't do one of these without talking about the MACD. So all the MACD is just, it's the distance between two moving averages, a shorter term moving average and a long term. And you can apply it to a chart of any time frame. And so what I want to show is when you apply that to a monthly price chart of the S&P 500. So here's what that looks like. If you take this all the way back to about the mid 90s, and the top panel is the S&P price, the bottom panel is that MACD indicator. And what you can see is, you see these periods like when we rolled over from the dot-com bubble going into the financial crisis. You see the MACD, that momentum indicator, kind of hit this peak level and start to roll over. Look at where we are today. Look at how far above we are relative to all these past prior periods. So just the momentum in the market, valuations, just everything's very stretched to the upside. Now, yeah, the big question is, how much could we fall? Well, Ted's pointed out how long we've gone without just even a 5% pullback. Look, it's going to feel bad when it happens, because this market, this is the fastest S&P's ever doubled in history. We hit double territory just in the past week, I believe. It's the quickest ever. We haven't had a 5% pullback. You get at least 2 or 3 of those every year. So they're commonplace. You average about 1/10% correction per year. So it would definitely not be out of the ordinary to see the markets fall into that 10% correction territory. Now, when you start going beyond that, more major sell-offs, thankfully, are pretty rare. Something I saw earlier today was showing that you've seen 9, 20 to 40% bear markets since 1945. So that's one about every 8.5 years or so. We had one last year. So hopefully we don't encounter anything like a serious bear market again, but something on order of 5 to 10%, that's definitely would not be out of the ordinary relative to what we've seen historically.
So Ted, I'm going to turn back to you. How does the market tend to perform in a period right after one of these really protracted bull runs?
Well, but before I address that, I just want to comment on something Clint mentioned. I mean, he talked about the number of big pullbacks historically, but remember, pullbacks don't necessarily mean bear markets. They can sometimes be a pullback in the middle of a longer secular bull market. And I'm on record as saying that I think we're still in one. Mm-hmm. And that even if we do get a big pullback, the underlying trends are still pushing the stock market upward. It's just the question is, we may have to take a break for a while because we have become so stretched. So let's look at a chart that shows what happens when you do have a big pullback after a market top. But the main thing here, I think, is to look at the median in the year following a market top and a pullback, because the averages are distorted primarily by a couple of outliers. The median return a year after a market top and when there's a pullback, whether it's a correction or bear market, is less than 1%. So it's a negative market. The 2 year is a little bit better though. It's 17.6, and the 5 year is 55%. On an average basis, if you have to include that special case of 94, 96. The average is 6.5 in the first year, 27 in the second year, 64 in the third year. But my guess would be that we would probably see something closer to the median. So what that means is that if we do have a pullback for whatever reason, whether it's Fed tapering or whatever, we could expect to see fairly flat markets for the next couple of years.
All right. And now, of course, the $1 million question. What works in the aftermath of one of these big drops? So again, and I asked this at the outset, how do we prepare for it? What do we do? How do we get ahead of it?
Yeah, let me start first. So just mention a couple of sort of rules of thumb. I think, particularly if the Fed were to taper, because I think that's the most likely scenario. I mean, I think the fears about Delta and growth are realistic, but eventually you have to think that that's going to be brought under control. The bigger question is, given the amount of support that central banks have given to the markets, what happens if they really do start to taper? And I recorded a video a month or so ago where I said that is the biggest issue facing all investors right now. So if that were to happen, it would be bearish, I think, for strong dollar sensitive stocks like commodities, because the dollar goes up, commodities tend to go down. And we're starting to see that with some of our own commodity positions. We're starting to see a pullback, and it's not just about growth worries. It's about the strengthening of the dollar in recent weeks. The second thing that it would be bearish for would be growth stocks, because if the Fed starts to taper and interest rate goes up, you know the drill. Your discounted forward cash flow calculations mean that those stocks are worth less just at a mathematical level, and they get sold. So that's tough environment for IPOs and SPACs and startups and all the exciting new companies that are supposed to deliver big growth in the future. It doesn't mean that they'll always be down, but it means for the next year or two you could find a really hard time making money out of those kind of stocks, because, as I said, I think they will come back. The ones that deserve investor money, particularly in new sectors like electric vehicles and renewable energy and robotics and automation, all that kind of stuff, artificial intelligence, those stocks will eventually start to regrow. But in the next couple of years, the new ones could be hard. It's bullish, though, for a very interesting set of stocks, the ones that we love. Here's a chart that shows the composition of market returns, really going back to the same time frame that Clint has showed, back to early 1900s. What's interesting, the green line is the growth of market valuations that come from multiple expansion. In other words, the willingness of investors to pay more for a dollar of future earnings. And you can see it's like clockwork. They tend to go up in euphoric markets, and then they crash. And then that willingness to pay more for future earnings is represented by that red line underneath. The second thing that's important, of course, is earnings per share growth. Now, after a collapse in multiples, in other words, when people say, hey, I'm not willing to pay that much for future earnings, and that falls, then most of your return comes from a combination of earnings per share growth and, you guessed it, dividends. So really what you want to do now is to focus on companies, that are going to grow their earnings because they have solid markets that are recession resistant, and they're non-cyclical. They perform well throughout the business cycle, and companies that pay high dividends. And that's something that we have been focusing on all this year. And that is precisely the reason why, because of this chart. Because if you look at the overextension we're in, the kind of green lines that we have right now, the history shows that your best bet is to load up on these kind of stocks. So that's what we're doing at the Bauman Letter. We're also, we're continuing to play the riskier stocks too, but we have to be a lot more cautious about it.
Yeah, and that does not mean you have to abandon the stock market altogether, like you're saying. So, one area of opportunity right now is to look at some stocks in the healthcare space. That's it's something I wrote about earlier this week, just because you look at just the healthcare sector in general. On next year's earnings estimates, it trades at about 16.9 times earnings versus, I mentioned the market at 21 or 22, and that makes it the third cheapest sector out there. Meanwhile, they're growing earnings, so expected earnings growth of about 14%. So that gives you kind of that growth at a reasonable price, that GARP type characteristic. But then, one more thing, especially as we're going into kind of an uncertain environment, one of the things I look at is how stable earnings are. Just like you can look at volatility of a stock's price, you can look at volatility of earnings. And here's a chart that just shows the volatility of quarter to quarter earnings for all the S&P 500 sectors going back 10 years. You can see, on the right-hand side, areas like financials, energy, that tend to be more exposed to the cyclical ups and downs of the economy. See big swings in earnings. On the left-hand side, you start to see, consumer staples is the lowest, but then healthcare. So they tend to see more stable earnings. That's something that is going to get a lot of attention with some of the challenges that are out there.
Right, and a good way to play that, for example, would be to look at an ETF like XLV, right, which is a healthcare ETF. And of course, don't just look at the ETF, go to its underlying components and then see if there's any that interest you, but that's one way to play it. I just want to follow up with two last observations about this. Clint mentioned uncertainty. Well, this is how uncertain things are. This is a chart that shows basically the Bank of America's range of estimates of where the 10-year Treasury yield might be at the end of the year. Look at them; they're all over the place. They go from 0.6 up to almost 2. So we're talking about the potential of tapering, but what Bank of America is saying, the external factors that are driving this market are so uncertain that we really don't know. We're guessing at this point. Somebody called it a barn door guesstimate. Just throw something, see where it hits. That's where it's going to be. So that's the one thing. The second thing I want to point out is that we just added to the Bauman Letter 2 picks that combine the two things that we've been talking about today. One is healthcare, and the other is dividend payers. And we've done that specifically as a strategy, based on what we're talking about today. But what we've added is a very unique way to play those markets that decreases the risk of exposure to individual stocks. I would encourage you consider subscribing. You get a year to check it out, and that's the first report you'd see.
Couldn't agree more. And as I said before, there is a link above or below. And I did want to mention one last thing before we wrap this up. I want you all to be on the lookout, because very soon Clint will be launching a new options service. We'll have a sign-up page for that soon. But of course, if you join the Bauman Letter, you'll still be first in line to know about it. So just another reason to join. Thank you so much, gentlemen. Always great to get your insights, and we'll speak again next week.
You guys all.